Every 3 months, a single announcement from Washington, D.C. can quietly shift thousands of dollars from your pocket to someone else's, or vice versa, without you even realizing it. This isn't some secret government plot, it's the direct impact of the Federal Reserve's Federal Open Market Committee, or FOMC. And if you're serious about building generational wealth and achieving true financial freedom, understanding their statements isn't optional, it's absolutely fundamental. The Federal Reserve is the central bank of the United States. Its dual mandate is crucial: maximize employment and maintain stable prices, which primarily means controlling inflation. The FOMC is the Fed's monetary policy-making body. 8 times a year, they convene, and after each meeting, they issue a statement outlining their decisions. The most impactful of these decisions? Changes to the federal funds rate. Now, you don't directly borrow or lend at the federal funds rate. This is the target rate banks charge each other for overnight lending. But it's the bedrock. Every other interest rate in the economy, from your mortgage to your savings account, is built upon this foundation. When the Fed raises the federal funds rate, borrowing becomes more expensive. This is their primary tool to cool down an overheating economy and combat inflation. What does this mean for you? First, your loans get pricier. Variable rate mortgages, home equity lines of credit, and credit card interest rates often climb. Financing a new car or a home becomes more expensive because the cost of borrowing that capital goes up. Second, and this is a silver lining for savers, your savings accounts, money market accounts, and certificates of deposit, CDs, typically start offering higher yields. Banks compete fiercely for your deposits, so they'll pay more to attract your money. Conversely, when the Fed lowers the federal funds rate, they're attempting to stimulate a sluggish economy. Borrowing becomes cheaper, incentivizing businesses to expand and consumers to spend. Your loan rates might drop, making it a more opportune time to refinance a mortgage or take out a new loan. However, the returns on your cash savings will likely fall, making it harder to earn significant passive income from liquid assets. Beyond these direct impacts, FOMC decisions ripple profoundly through the broader investment landscape. When rates rise, companies face higher borrowing costs, which can dampen their future profits and, consequently, their stock prices. Higher interest rates also make fixed-income investments like bonds more attractive relative to stocks, as bonds offer a safer, often competitive return. This can lead to capital flowing out of the stock market and into bonds. When rates fall, the opposite often happens. Cheaper borrowing can boost corporate earnings, and lower bond yields make stocks more appealing, potentially driving up equity markets. Now, you might be thinking, this sounds complex. Do I really need to track every single Fed meeting? Not every granular detail, but understanding the direction and rationale behind their moves is absolutely crucial for crafting and adapting your long-term financial strategy. Are they signaling more rate hikes to combat persistent inflation? You might consider locking in a fixed-rate mortgage now, or strategically shifting some cash into higher-yield savings products or short-term bonds. Are they hinting at future rate cuts to prevent a recession? This could be a signal to evaluate refinancing opportunities, or to consider increasing your equity exposure if you have a long-time horizon and a strong risk tolerance. The key here is calm, informed decision-making, never panic. The Fed's actions are rarely a surprise, they are often telegraphed through public statements, economic forecasts, and speeches from Fed officials. By paying attention to these signals, you gain a significant edge. You can anticipate broader economic trends, adjust your personal portfolio, and proactively protect your purchasing power. This isn't just about reacting, it's about proactively positioning yourself for enduring financial freedom. When you truly understand these powerful forces, you stop being a passive recipient of economic tides. Instead, you become an active navigator. You learn to read the currents, adjust your sails, and ensure that those thousands of dollars stay right where they belong, in your pocket, diligently working for your future. Just as that initial announcement can shift your financial reality, your informed understanding of it empowers you to shift it back, decisively in your favor.